Good morning and welcome to the first True Network Advisors webinar of 2024. My name is Matthew Canova with Maynard Nexon, and today we're going to cover what sometimes is a favorite topic, sometimes is the least favorite topic, but is ACA reporting. And we want to talk today about what we call the 2024 ACA reporting season. Now keep in mind that is actually reporting for the 2023 calendar year. I think there was some confusion with that sort of towards the beginning, and especially we'll kind of talk about a little bit of it today. But when you think about determining your applicable large employer status, and then the year that's in question for things like a measurement period, and then reporting, you're really talking about several years that you have to take into account. And so that's why it's kind of important to specify, you know, the year, the filing year, reporting season, things like that. But the forms that are filed in 2024, just like your personal income tax return, are filed in the year subsequent to the year in question or the applicable year. So for 2024, we're actually filing the information that relates to the 2023 calendar year. The ACA reporting that we're talking about today is specific to applicable large employers. So employers with 50 or more full-time employees in the preceding calendar year. Now, remember what I just said, you know, kind of there's several years we have to think about. So when I'm talking about, are you an applicable large employer that is required to file the 2023 forms that are filed in 2024, what we're really asking is, were you an applicable large employer in 2023, which is based on the preceding calendar year, meaning 2022. That's where I say we have several years kind of in question. Now, likely, or if you're on the call today or aware of ACA reporting, you likely already know whether or not you are an applicable large employer. We may have some employers that are really kind of close to the line that have determined that they're not applicable large employers yet, but they see some growth in their company's future, so they need to know about these requirements, but they're not quite there yet. You may be an employer that has known your applicable large employer status, you know, you're well over the 50 number, or you may be, again, when somebody was kind of in right on the line and did determine that you are an applicable large employer. And of course, learning or knowing your applicable large employer status, which I'll say a few times as ALE status, ALE status, is important not just to know that you're subject to the reporting requirements, but you're also subject to the employer mandate, which is what we are reporting about on these forms. So that you know that you have to offer coverage to full-time employees to avoid that penalty. And I always like to clarify how the employer mandate works a little bit here, because how I just said it, you know, because you have to offer coverage to full-time employees or pay that penalty. Well, I could probably say that about really anything, you know, but there's a lot of requirements out there for your employee benefits or for you as employers that if you don't do it, you're subject to a penalty. Well, you know, in most situations, you are, quote, required to do those things and will be penalized for failing to do so. Now, while that sounds a lot like what the employer mandate is, the employer mandate actually does not say you have to offer coverage. In other words, you're not doing anything wrong by not offering coverage or not offering affordable coverage to your full-time employees. It really is, as you've probably heard it be called, the pay or play mandate. In other words, it gives employers a choice. You're not doing anything wrong. You're not violating any laws by not offering that coverage. The IRS basically gives you a choice between offering that coverage or potentially being subject to a penalty, because you're not necessarily guaranteed a penalty if you don't offer coverage. A few things have to fall into place, and we'll talk a little bit about that. But there are a few things that have to fall in place for you to actually receive that employer mandate penalty. Now, I will say, you know, kind of a caveat to that, or with that being said, most of the time, if you are an applicable large employer and don't offer that coverage, you're likely going to be receiving a penalty, because one of the factors for receiving a penalty is that at least one full-time employee gets an exchange subsidy. And while the exchanges are not quite as popular, I think, as the IRS and the government when the ACA was passed expected them to be, there still is some interest there, especially if they're not being offered coverage. I mean, most employees, and in particular certain demographic of employees, are more likely to go to the exchange because they need coverage. And this is not, you know, meant to single out anybody in a negative way, But if you think about individuals that will definitely need coverage, of course, anybody that has a health condition that they need insurance for. But I would say the biggest target group for exchanges that you can be pretty confident they're likely to go to the exchange are single mothers, and that the reason there being is they need coverage for themselves, but also for their children. And so you can expect that if you're not offering coverage and you're an after-large employer, that you will have some employees go to the exchange, receive a subsidy, which means that you can be assessed an employer mandate penalty. And in particular, if you have employees that are single mothers, those are the most likely, I would say, to go to the exchange. So now back to the slide. Let's talk a little bit more about kind of an overview of what we're going to talk about today, and then some important updates. Again, we're talking about after-large employers. The forms that we're talking about are what we commonly call the C forms. So that's the Form 1094-C and the 1095-C. There are similar and very related forms that we call the B forms, 1094-B and then Forms 1095-B, that are filed primarily by insurance carriers, but they're filed by any providers of minimum essential coverage. That can also include if an employer who sponsors a self-funded plan. Now, that's not to say that there are no, well, let me say it differently. Normally, if an employer has a self-funded plan, they are also an after-large employer. And in that case, they would just file the C forms. They wouldn't file the B forms and the C forms, even though the B forms do apply to providers of minimum essential coverage, which would include a sponsor of a self-funded plan. But instead, they would use the C forms to kind of kill two birds with one stone, because there's a section of the C forms that meet the B form criteria or has the same information. So normally when we're talking about B forms, that's going to be the insurance carrier. What led to a lot of confusion, well, before I move on there, but again, if there are employers that are small employers, in other words, not an after-large employer with self-funded plans, they would not use the C forms, they would use the B forms. Today, we're going to focus, as I've mentioned a few times, on after-large employers and the filings for them, so we're going to focus on the C forms. Something that's interesting with the B forms is there's actually some exceptions now that have been put in place that allow insurance carriers or employers subject to the B form requirements to avoid filing those, because the B forms are primarily geared towards determining whether an individual is eligible for a premium tax credit, and whether those employees, but also whether those employees are subject to the individual mandate penalty. So not the employer mandate penalty, but the individual mandate penalty. Well, as you likely know, and as we've mentioned several times on our webinars in the past, and your true network consultant is likely, you may have had discussions with them about it, is the individual mandate has now been effectively repealed. It's actually still in the law, but it's just been amended to be $0. So effectively repealed, and we don't really see anything on the horizon that would be changing that. So for the time being, until we have some drastic change, if and when that occurs, which is unlikely to happen, then the B forms are kind of unnecessary. That doesn't mean the IRS doesn't want their information. So they haven't outright said they're no longer ever required, but there are some exceptions that those subject to the B forms can fall under, and then would not have to provide those B forms. But those exceptions do not apply to the C forms. And importantly, if you are an after-large employer that would also, so you're also a provider of minimum essential coverage, so you have a self-funded plan, so you would have been subject to the B forms, but you can use the C forms to meet both requirements. Even though you would be able to get out of the B forms, you are not out, you do not get out of the requirement to file C forms or the requirement to file the B form information on the C forms. I know it's a little bit confusing. If you're familiar with the 1095-C, that's what we're really talking about. It's that Part 3 of the 1095-C where you list all of the covered individuals. That's really the B form section. So again, if you're subject to both requirements, let's say as a large employer and as a provider of minimum essential coverage, that Part 3 is still required for you. There are penalties for failing to file the ACA reporting forms, and that's that's kind of what we're thinking about today is we got to get these filed. We don't want to be penalized for failing to file them. But keep in mind that what we file on those forms is what determines the potential employer mandate penalties that will apply. So I always think about there's really two very important purposes of these forms and what we're talking about today. One is to get those filings done, right? Because failing to file in and of itself has a penalty, but the information we report on those, just as importantly, can result in employer mandate penalties. So we want to be sure to get the filings completed and also to complete them correctly with information that will not result in a penalty. The last two bullet points here are some new information. We'll talk a little bit more on the very next slide about the new threshold for filing. But previously, you had an electronic filing requirement only if you filed more than 250 forms. But when we talk about those forms, we're specifically talking about the 1095Cs and the 1094C. Now, the new rules have changed that to from 250 all the way down to 10, and we're going to count a lot more forms. But we're going to talk a little bit more about that on the next slide. So I'll move on to this last bullet point. And this has actually been the case for now, I believe, 2 filing years. But there was previously good faith transition relief for the information being reported. Good faith relief has never applied for the requirement to file. So in other words, it never applied to penalties for failure to file or delinquent filing, at least officially. We know in working with the IRS and representing a lot of employers that had filing failures that the IRS was really approaching it with more leniency. And even though the good faith relief may not have technically applied, they were applying what I would call less than a reasonable cause standard, which is what the standard is in the law. Well, both for delinquent or failure to file penalties and for any penalties related to the information that is filed, the good faith transition relief no longer applies. So we moved on to a reasonable cause standard, which is still a relatively low standard compared to any more stringent standard that could apply, but it is more difficult than good faith. Good faith is really the lowest standard we see in IRS matters, and reasonable cause is a significant difference there. And if you think about the amount of time that has gone on since these requirements were put in place, that's why the IRS is saying, okay, we're going to be less lenient, and we're going to be more stringent in our review of these failures because employers have now had more time to get acclimated, get familiar with the requirements, and to meet those requirements. To give you kind of an idea, of maybe to put that in perspective, but before the webinar today, I was thinking, this is the first webinar of 2024, and I was kind of thinking about, okay, the last sort of major change I think was COVID, right? And it's now been not quite 4 years. I think in March it'll be 4 years when the world basically shut down because of COVID, and it's hard to believe that is almost 4 full years ago that has happened, and it still affects us, in today's life. And a lot of companies are still sort of, whether it's bouncing back or implementing adjustments that went in place. A lot of companies, have done extremely well since then, and some due to COVID. But it's just kind of crazy to think about the time that has gone by and how long it has been since even then. And then to kind of bringing that back, the IRS is thinking, listen, these rules have been in place since technically 2014, but first implemented 2015. So they're thinking employers should have gotten on board and be familiar with these reporting requirements by now, so they're less willing to be flexible when an employer has failed to file or has filed incorrect information or completed the forms incorrectly, kind of with an excuse of, well, we just didn't know any better. They're less willing to take those reasons. And so whenever we have to deal with challenges, we want to look for all the circumstances. What was going on at the company? Did we have turnover in the HR position, the HR or the benefits, or whoever was responsible for these forms? Were we working with the broker? Were we not working with the broker? Which broker were we working with? All of those things we want to use to kind of create a picture of why, if we had a failure, why that failure occurred, and why, because we're now under the reasonable cause standard, the failure was due to reasonable cause and not willful neglect, because we can't use the good faith standard anymore. So I mentioned on the last slide that there's some new things for 2024, and primarily what we're talking about is whether or not you're required to file electronically. Now, most employers, I would say, especially if they were filing around 100 forms, we're filing electronically anyway, so this is not going to be a huge change for everyone, but you at least have the ability to file on paper forms if you filed fewer than 250, and it only counted the actual forms we're talking about, so kind of one type of form, so really the 1095C. Now that standard has been lowered to where if you file 10 or more informational returns, which is a broad net, then you're required to file electronically. The easiest examples of, quote, informational returns would be W-2s and 1095Cs. So that means basically, unless you have a very small number of employees, which means you're not subject, you would not be subject to these rules anyway, then you're filing electronically. So I'm going to really just go ahead and assume that everybody on today's call is now subject to the electronic filing requirements. And this also applies for other informational returns, but again, we're focusing on the ACA returns today. Electronic filing is not the end of the world. I do think it is more difficult than it needs to be, and if you've done it before, you probably agree with me there. But it's not that difficult. Typically, your payroll provider, already, if you have a HRIS system along with your payroll provider, it likely has an ACA reporting platform or module in there to make it as seamless as possible. Now, those programs don't always have the ability to actually file or transmit the files to the IRS, but most software now does have the ability to at least create the electronic file. It'll be an XML format. If you are in that situation, you don't have the actual ability to file, talk with your true consultant. They can connect you with providers that are able and registered to actually transmit those filings. So, essentially, you have to have somebody that is registered to, for lack of a better explanation, upload those and then click the button to send them to the IRS. There's a little bit more involved, as you can imagine, for that. But if your payroll software provider doesn't have the ability to actually transmit them for you, as long as they have the ability to create the XML files, then the next step is not all that difficult, and your true consultant can certainly connect you with people who can. We work with them very regularly to do so. We're registered to file those, so we can assist with that. The more challenging part is actually creating those XML files. And I do believe that your true consultants have connections with software providers that can do so. But if you're able to keep it all within your payroll system, then a lot of that information is already in there, and it's a little bit more seamless. But you want to make sure that you're familiar with the capabilities of the software that you have so that you're ready and able to meet the filing deadlines that are coming up. So moving on, we want to talk about some common challenges that we see for employers. Now, I mentioned earlier, we're talking about the after large employer filing requirement. Well, a lot of employers, if they look at their own company, have fewer than 50 full-time employees, and they say, okay, good, we're not subject to these rules. But they don't take into account any common ownership with other companies. So we always, and this is important for two reasons. One is determining your L status, and two is how you file. So if you are yourself, looking at just your company, and maybe you have one location, and you have fewer than, let's just say you have fewer than 50 employees, period, not even only fewer than 50 full-time, but you don't even have 50 people working there. But there is common ownership with another company. Well, that doesn't necessarily mean you automatically have to combine those companies and count all of the employees. You would then look at the controlled group and the affiliated service group rules, which we have covered in prior webinars, and it's way too much to cover in combination with another topic. So we don't have time to go into incredible detail with those, but generally your magic number is always 80%. And so if there's common ownership of at least 80% between you and one or more other companies, you're likely going to need to combine the number of employees that you have. And so while your company itself may not have 50, when combined with that other company or multiple companies, that may push you over the line to be an ACA employer. And that means you, as well as all of those other companies, are treated as what's called an AL group, and you, the individual company, would be an AL member. Now, I mentioned that's important for AL status, but also how you file. Well, if you are an AL group and you have AL members, each AL member has to file its own forms. A good way to think about what is an AL member is an EIN. If you have different EINs, the forms treat you as really your own entity, or a member of an AL group if there are multiple entities in there. So every EIN will need to have a Form 1094C authoritative transmittal. And that really just means that there's a box on there that you check, and that 1094C is going to only apply to your company or your EIN. But there are situations where there may be multiple entities that all have the same EIN, and the IRS looks at that as different divisions of a company. That may not be your terminology, but that's how they look at it. And all of those would still be filed under the one EIN. The rules do actually allow each, quote, division to file their own forms, but there still needs to be only one authoritative transmittal for the EIN that communicates all of the information for all of the divisions under that EIN. As with anything, sometimes this sounds complicated. I can promise you it's not quite as complicated, but it also isn't uncomplicated. So any follow-up questions that you have, of course, submit them in the chat today, but also work with your true consultants. They've been dealing with this since 2014 and 2015 as well, so they're getting very, very familiar with it, and they can help you determine. We know we have multiple employers or multiple companies within our group. We're not exactly sure how to get these forms correct with the divisions versus the EINs, AL members, AL groups, so on. So they can definitely help out with that to make sure that you get your filings done correctly. So what are the deadlines this year? I've got the paper filer deadline there in yellow because, again, I'm virtually certain that it's not going to apply to anybody that is subject to these rules, but so that you know, there's that deadline. But more likely what we're dealing with are the electronic filing deadline, which is March 31st of 2024. Now, there's been an automatic extension. Well, let me back up a little bit. So you have two requirements that we're really talking about with these forms. You have the requirement to file them with the IRS, and then the requirement only with respect to the 1095 fees to provide them to the full-time employee that it relates to. So there's the employee statement aspect of it. That's what's there on the right, and that deadline is March 2nd. That deadline has always been, and still in the law, is January 31st. However, the IRS has put in place a permanent automatic extension to March 2nd. So each year the deadline will be March 2nd for providing those statements to employees. The electronic filing deadline, so that's the deadline to actually get these to the IRS, is March 31st. One thing that's always a little bit it's not necessary for the deadlines to really be different, because if you have to get these forms to employees by March 2nd, well, that means you necessarily have them ready by March 2nd. And so, could file there, but you really have, I guess, an extra 29 days to get that process done. Rarely is there going to be a significant change, but you may, after you've provided them to employees, find that there's information that needs to be corrected, or sometimes it just takes some time to get with the filer, not necessarily the entity or payroll software that created the forms, but with whoever's going to submit them and get those submitted on time. But I always like to highlight the March 2nd deadline a little bit more than that March 31st deadline, because practically speaking, you need to have everything completed by that March 2nd deadline so that you can meet it. And then you'll have, a little bit more of a buffer for getting them actually transmitted to the IRS. So focus on that March 2nd deadline. That's when we need to have all of that information to our service provider so that they can create those forms and we can get those distributed to our full-time employees. Now, I mentioned earlier that the information we submit on these forms is going to have an enormous impact on whether or not we're subject to an employer mandate penalty. Here are the penalties that are 2023 penalties, again, that would be assessed based on the filings we file in 2024 that are for the 2023 calendar year. Now, realistically, you won't see these penalties if you are assessed one for likely at least 2 years, so I would expect maybe 2026. The IRS typically is about 2 to 3 years behind. It's been more like definitely 3 years, maybe even longer for the last several years, but they're really, most of the notices that we've seen from clients are about 2 to 3 years kind of behind, not necessarily behind schedule, but after the year in question. So for example, right now we are dealing with a lot of 2021 penalties from the IRS, it being now in 2020, 2024. So talking about those employer mandate penalties, we have almost $3,000, so $2,880 for the A penalty, $4,320 for the B penalty, which seems like it's the larger one, but it's actually generally going to be the smaller one, and it can actually by law cannot be greater than what the A penalty is. So let me explain that. So the A penalty applies if you fail to offer coverage to at least 95% of your full-time employees. If that is the case, then the employer is subject to an employer mandate penalty, the A penalty of $2,880, which is for the year. The penalty is actually assessed by month, but it would be subject to the A penalty for every single full-time employee, not just employees that we failed to offer coverage to, but every single full-time employee if just one full-time employee obtains an exchange subsidy. That's why I mentioned earlier, that even if we don't offer coverage or we're potentially subject to penalties, doesn't guarantee that we're going to get hit with a penalty, but it's pretty likely that, especially if you didn't offer coverage to at least or to any full-time employees, but even to less than 95%. In most cases, you will have a full-time employee that obtains an exchange subsidy, which again means you are subject to an A penalty for all full-time employees. Now, if you do offer coverage to at least 95% of your full-time employees, which means, and let's say we offer it to 96%, so that means there's 4% of our full-time employees that were not offered coverage. Or even if you offer coverage to everybody, but the coverage fails to meet minimum value requirements or is not affordable, which is what's covered there in that last line at the bottom of the table, then we're looking at the B penalty. Even though the penalty number is greater, it only applies for full-time employees who obtain an exchange subsidy. So that's where kind of the difference is. The per employee penalty is lower on the A penalty, but it applies for all full-time employees, where the B penalty is larger on a per employee basis, but it does only apply on a per employee basis and only for those employees that go to the exchange and get a subsidy. You'll see the affordability percentage there for 2023 is 9.12%. Now that number is used in two very important ways, and in really I would say very different ways. So the first is based on their household income, and that determines if the employee is eligible for an exchange subsidy. That's between really them and the exchange. The exchange is supposed to send what's called a Section 1411 notice to the employer, basically verifying the information that was provided by the employee. They have not done that in the last several years, and I don't expect them to change that. And we'll talk a little bit more about those. That's one way we've used to challenge employer mandate penalties. We know the IRS is not really open to that challenge. Their position, which I could go on for a very long time about the holes in their position, but is that the actual employer mandate penalty notice is the Section 1411 notice. But for a lot of reasons that we don't have time to talk about today, that doesn't make sense under the law. And if push came to shove and the IRS had to go to court to defend that position, then I feel very confident they would lose that. That gives us a little bit of leverage whenever we have a penalty, because again, they're not following the procedures that were established by Congress in assessing those penalties. And if they're not, then that gives us a little bit of leeway and leverage, because again, if they had to defend sort of their position, they don't have the ability to trump Congress. I mean, that is constitutional law right there. And so that we're able to use that as leverage, but we also do know that the IRS is not very open to that argument. So switching back, so 9.12%, the affordability percentage is important for determining whether they're eligible for an exchange subsidy. But for us, for employers, it's really more important in looking at the safe harbors. And the main reason for that is we don't know the employee's household income. We know what we've paid them, but that doesn't mean that is their household income. We don't know, they may have a spouse that's working, other people that in their household that work, that go towards that household income. Now, normally that means that their household income, is going to be larger than the income that we know about. But that's not always the case. There are actually some things that can reduce household income. That gets into some tax law, and you may be familiar with that from filling out your own individual tax return. But ultimately, because we don't know their household income, there have been safe harbors that have been set up for employers to use, that even if our coverage is unaffordable based on their household income, we shouldn't be hit with an employer mandate penalty because we satisfied a safe harbor. And we'll talk about some of those in more detail coming up. Oh, and real quick, I have a slide that we'll talk about towards the end that is basically this exact slide, but for 2024, just kind of looking ahead so that we know the numbers we're looking at for 2024. Some other common challenges that we see are, who is a full-time employee? Now, similar to what we just talked about with the 9.12%, that it serves multiple purposes. Well, so does the term full-time employee. And probably not so surprisingly, it can be complicated. We've talked already about, are you an ACA large employer, meaning do you have at least 50 full-time employees? And that's 50 full-time employees in the preceding calendar year. For 2023, that would mean we're looking at 2022 employment data. Well, when we're talking about full-time employees for who gets a 1095-C, that is looking at the year in question. So who was treated as a full-time employee during 2023. So as if that's not complicated enough, then it's, well, how did you determine full-time employee? Well, the month-to-month method, or really it's called the monthly measurement method, effectively is what it sounds like. It's, okay, in each month, because remember, those employer mandate penalties are actually assessed on a monthly basis. In each month, was this particular employee full-time or not? And that is based on a 130 hours per month standard. So if somebody works 130 hours in a month, they are considered a full-time employee for that month. When we think about the 1095-C, why that can be important is you may have an employee that is not full-time for 11 out of the 12 months, but they were for 1 month of the year. Well, that employee still has to get a 1095-C, and would also have to, have the information about did we or did we not offer them coverage. Now, let's say that they are considered a full-time employee for March 2023. If we didn't offer them coverage in that month, that's going to go into that 95% calculation and would be considered a full-time employee for March, and we could potentially be subject to a penalty even if we pass the 95%, but for that employee for that 1 month. For the other months where they were not a full-time employee, we would not be subject to a penalty for that employee because the employer mandate only requires that we offer coverage to full-time employees. Well, that can get difficult, right? If we have a lot of employees, we're having to monitor every single month, are they or are they not full-time employees? Do we or do we not offer coverage, especially if we have an employee like the one in my example where, they're generally not a full-time employee, but they just happen to work 130 hours in a particular month, or maybe it goes up and down. You've probably heard the term variable hour employee. That's why we have the look-back safe harbor method of determining a full-time employee. Now, we've talked about this, and this is something that I do think is very important for all of you to know and to be familiar with. The method you're using to determine full-time employees, this likely is already set up and structured within your HRIS or with the people that administer your benefits at your company. If not, I would encourage you to immediately reach out to your true consultants to get this straight, because this can become extremely important when we're talking about employer mandate penalties and completing the reporting. But the look back measurement method is what it sounds like. And again, kind of going back to what I've said a few times, where a lot of times there's multiple years in question that we have to think about. So we're talking about, okay, for 2023, was this employee full-time or treated as full-time? Well, treated as means that we use the look back measurement method, which looks back on a period of time to determine full-time status. And then it's called the stability period, but I like to call it the locked-in period. And they are treated as a full-time or non-full-time employee based on their hours during that look-back measurement period. The idea behind it is to avoid having to do that monthly measurement where we're looking and saying, okay, did this employee work 130 or not? You know, we're having to do that for everybody. And if you think about that, we don't know if they worked over 130 until the end of the month. Well, let's say that we didn't expect this employee to work full-time during that month. We didn't offer them coverage. Turns out they did work full-time. Well, it's too late. Now they weren't covered. And that also can lead to, employees coming in and out of the plan many times during the year. So from an administrative standpoint, even though the look-back method can be complicated on the front end, it generally works out better because it gives you kind of some more certainty for a longer period of time for that locked-in period of their full-time status instead of having to do that monthly. But it does involve kind of setting it up on the front end. And the trade-off is that even if their hours fluctuate during the initial measurement period, during the locked-in period, the stability period, they're still locked in to their full-time status during that locked-in period because it's based on the measurement period preceding that locked-in period. So flipping back to affordability, I mentioned the 9.12% is important for several reasons, and most importantly for us, for those safe harbors. Now, 9.12% is what was applicable for the 2023 plan year. I know we're talking about ACA reporting for 2023, so that's what we want to focus on today, but just, kind of an FYI, and as you're looking at your compliance for 2024, the 2024 percentage is 8.39%. It's the lowest that the affordability percentage has been to date. And so make sure we reflect that and we take that into account when we're setting our premiums for 2024. But the safe harbors are the most important thing to talk about with affordability. So I want to walk through those, and in particular, kind of talk about the what can affect the ability to use certain safe harbors. So the first safe harbor that we want to talk about is the Form W-2 safe harbor. And this is what it sounds like. It's based on the employee's W-2 and their Box 1 W-2 income. The affordability percentage, again, is 9.12%. And the safe harbor saying, because, again, we don't know their household income, is as long as the coverage was affordable based on their W-2, which means that it was no more, the employee's share of the cost of coverage, of single-only coverage, was no more than 9.12% of their Box 1 W-2 income, then you've satisfied that affordability safe harbor. So even if the employee got a premium tax credit because the coverage was unaffordable based on their household income, we don't get hit with a penalty because we've satisfied the safe harbor. And the reason these are important is because, again, we don't know their household income, so it gives the employer the ability to use the affordability percentage and information that we do know. Now, something that's challenging with the W-2 safe harbor is while we may know that information at the end of the year, we don't know it during the year. We can estimate what it's likely to be, but there are a lot of things that can affect the W-2 income. And in fact, there's kind of this never-ending math problem that I really think is the main or a huge problem with the W-2 safe harbor. But I've got on this slide and the next several slides strings attached. And the W-2 safe harbor is really the one that comes with the most strings. Again, it's determined at the end of the calendar year. If we use the W-2 safe harbor, we're kind of locked into it. In other words, we have to use it for all months of the calendar year or of the plan year, if it's non-calendar plan year, and can't kind of shift through different affordability safe harbors, where the others we really can. Let's say if one worked in 1 month and the other, there's the FPL safe harbor and the rate of pay safe harbor worked in another month, we can actually shift those. Ideally, we wouldn't need to do that, but the W-2 safe harbor doesn't give us flexibility. We'd have to stick with it. The never-ending math problem that I mentioned. So if you think about the box one W-2 compensation, it is the compensation net of things like 401k contributions and pre-tax premiums for healthcare, right? Well, if what we're trying to determine is how much to charge for our health plan, whether for all employees or for a particular employee, and that number is going to impact what is in box one of their W-2, well, then every time that number changes, it changes one of the variables of our equation, right? And so by taking the amount, let's just say to easy math, $10 a month out for those premiums, their box one W-2 income has just gone down by $10, which means that if we set it at 9.12%, our coverage is now unaffordable because that 9.12% of X, the box one income, X is now a different number. It's $10 lower. And so then, you adjust it a little bit. Well, now that W-2 income has gone up. And so again, it's kind of a never ending math problem. That's why if you're using the W-2 safe harbor, we generally recommend giving yourself a margin of error. So something like if it's 9.12%, use 9%. And that way you kind of create a buffer there to help with the never ending math problem. But it is something that really you would have thought that the IRS kind of would have thought through for that safe harbor. But they're thinking maybe that, hey, it's a safe harbor, we don't have to make it perfect because we're giving you a way around the household income. Next, we've got the rate of pay safe harbor using the same percentage, again, of 9.12%. The way the rate of pay safe harbor works is we get to, instead of with the W-2 where we're using their actual box one income, the rate of pay safe harbor lets us calculate a monthly income based on their rate of pay, and that's our affordability number, even if the employee makes more or less than that amount. So it works on a formula. We would have their rate of pay times 130. Remember, that's the full-time standard. So their rate of pay times 130. And as long as our premiums for our employees' required contribution for the premiums for self-only coverage is no greater than 9.12% of that number, their hourly rate of pay times 130, then it satisfies this affordability safe harbor. Now, I'm talking about it sort of in the abstract of we're checking how much those premiums, or if those premiums were affordable. More likely, how you would determine this is you're saying, okay, what can we charge? What will be affordable? So you would say their hourly rate of pay, let's say it's $10, times 130, times 0.0912, and then the answer there is the maximum employee required contribution that you can have for it to be affordable for that employee. Now, all employees are going to have, or a lot of employees are going to have different rates of pay. You don't have to say, okay, what's our lowest paid employee, and then calculate that formula. And let's say that number gives you $200 a month, and set it at $200 for every single employee. You're not required to do that. You can have this be truly different for all employees. A lot of employers will do that. They'll say, let's take our lowest paid employee and calculate what would be affordable for that employee, and then apply that for everybody else. Again, that's not required, but that is a common practice. Another approach could be to sort of take, somebody who's kind of in the middle in terms of their hourly rate of pay, calculate it based on that. And so anybody from that person up would have that amount, and then anybody from that person down, you would either calculate it per employee, or maybe for them you would use the lowest cost or lowest hourly rate of the employee. But again, there's no requirement, and necessarily under these safe harbors, it suggests that it is permissible to have those different premium amounts for different employees because it's based on their hourly rate of pay. Now, again, these all have some strings attached. So and the rate of pay safe harbor is no different. if you are using the rate of pay safe harbor, we have to use the lowest hourly rate of pay for that particular employee. In other words, if during any month, so if their rate of pay goes up during the year, you still use their lowest rate of pay either during the month or during the period of coverage, which is going to be the plan year. So pay raises don't change the safe harbor amount. It can be complicated for non-hourly employees because obviously we're talking about the hourly rate of pay. In that situation, you can use the monthly salary as well. Now, in most situations when we have somebody that's not an hourly worker that's on salary, and in most cases we have not found it to be a problem. It's normally going to be affordable for those employees if you use the amount that you're using for hourly employees. But to calculate it specifically for those non-hourly employees, you would just look at the monthly salary. A significant drawback of the rate of pay safe harbor is that it just does not work for tipped or commissioned employees, or employees paid really on kind of some sort of special basis that doesn't cleanly fit into an hourly rate of pay. I think that there is a very easy solution to this. Tipped employees, they may make, $2.50 an hour, and then obviously their tips are what makes up the difference, and that's why those employers are allowed to pay them less than minimum wage. Well, it seems to me that you could default to making the assumption that they're making at least a minimum wage when you factor in their tips. You could, of course, take their actual tips, factor those in, and determine an hourly rate of pay. That could be difficult. So I think that a solution here would just be to allow employers in this with tipped employees to make the assumption that they're making at least minimum wage, which they are doing for legal purposes already, because if they're not allowed to assume that, then they're required to make sure these employees make minimum wage. So I think that is a clear and relatively straightforward solution to the problem of not being able to use the rate of pay safe harbor for tipped employees. But the IRS has clearly said rate of pay safe harbor does not work in those situations, and until we have a change in that position, we are not permitted to use the rate of pay safe harbor for tipped or commissioned employees. So we have a third safe harbor. Now, as you'll see, this has very few strings attached. Unfortunately, it also generally results in the lowest employee required contribution, and by the flip side of that, the highest employer contribution towards the cost of that coverage to make it affordable. But it is very straightforward. Similar to the rate of pay safe harbor, and unlike the W-2 safe harbor, what it does is it allows us to assume an amount instead of based on their actual W-2. Also, instead of what their actual rate of pay is, it just says, what is the FPL? Look to the federal poverty level that is established by the government each year, and as long as you make it affordable for somebody making right at the FPL for a single individual, then it is affordable under this safe harbor. So, of course, it's the easiest, but again, that does tend to be the lowest amount. But there's very few limitations there. You can use it for some or all months. It allows you to use the qualifying offer method, which you may be familiar with. That's where you use 1A as the code for line 14 on the 1095C, which means you don't have to complete line 15. It makes it a little easier, but not a significant thing. So I generally like the rate of pay safe harbor the best. When we're working with employers to determine if things are affordable, because they've received a penalty, now these safe harbors are, of course, designed to help you determine the level of premium. But when you receive a penalty, you need to go back, and if you didn't already use a safe harbor, we can kind of use one in effect retroactively. But our goal is to show that it was affordable based on one of the safe harbors, and often the rate of pay safe harbor is the best to go with. Now, fortunately, again, I mentioned that the W-2 safe harbor can be problematic because we don't know what the W-2 is until the end of the year. Well, when we're looking back, because we've received the penalty, let's say we receive it in 2024 for the 2021 calendar year, that, remember, was reported in 2022, right? Well, then we know those numbers. And so really what we generally use is kind of a kitchen sink approach. Hey, if any one of these three work, we're going to use it. the rules, the regulations do specify that we're supposed to use the same affordability safe harbor for employees in the same classification of employees. There are different sections of the rules. Some say these are the only classifications you can use, and another section of the rule says that you can use any reasonable classification or category of employee. Fortunately, the safe harbor rules let us use that any reasonable classification of employees. So ideally, we would be able to make one safe harbor work for everybody in question. And the way that these penalty notices work is they give it what's called a PTC listing. Those are the employees that have received a premium tax credit. Ideally, we would be able to use the same safe harbor for all of those employees. But if not, we want to be as aggressive as we can in challenging these penalties, so we'll use different safe harbors. With the more time that goes on, the leniency there and the follow-up questions may increase from the IRS. But we've had a conversation with the IRS. Now, this was several years ago, but we were talking about, using this safe harbor, but we weren't going to use it for all months. And frankly, the IRS said, we're not worried about that part. We just want to make sure that they satisfy the safe harbor and that they get the forms filed correctly. So at least in prior years, they were not as concerned about some of the strings, like using it for all months if you use it for any month, which is what the W-2 safe harbor requires, or, the using the same safe harbor for reasonable classifications of employees. They didn't ask those follow-up questions. Now, we always want to be thinking ahead because those questions can be answered. We want to have a defensible position in the safe harbors that we use, but that's just kind of an interesting development that we learned at that time that gives us a little bit more comfort in using those different safe harbors. All right, so moving on, talking about the codes that are on the forms. I'm not going to talk about all of them. A lot of them are fairly straightforward, and I've got in a few slides kind of our what I call the Trump codes, right? And sort of the really important takeaways for reporting and kind of some good rules of thumb. But there has been a lot of questions from our clients about the conditional offer codes, and those are 1J and 1K. These have been around for, I think, 3 years now. They weren't in the original reporting, but I believe 2 or 3 years ago, they were added as optional codes for line 14 to the 1095C. So if you make a conditional offer of coverage, so that's something that would be like, okay, you're offered coverage, the spouse is offered coverage as long as they are not covered under their employer's plan. That's where these codes come into question. If you are offering coverage to the spouse, whether or not they have coverage, and maybe that spouse or really the employee declines family coverage and doesn't cover the spouse because they went and got the spouse went and got their own employer's plan, that's not a conditional offer. It's only a conditional offer if there truly is a condition on that. So that's code 1J and 1K. And so if you do have conditional offers, those are the codes that you want to look to. And one thing that we kind of learned from that is keeping in mind that there are options for how you offer coverage, and you can place those types of conditions on it, and that's not violating any rule. And keep in mind that the employer mandate says that you are, to avoid those penalties, you must offer coverage to full-time employees and their dependents. That does not include the spouse. So there is no requirement under the employer mandate to offer spousal coverage. And in fact, if you do not, but you do offer coverage to the full-time employee and dependents, then you would still be meeting the requirements to avoid those employer mandate penalties. So another complicated area for ACA reporting is COBRA. I think when you take away, you try to see the forest and not all of the complicated trees, it makes a little bit more sense in terms of how you report for COBRA. But there can be some complicated situations that arise, and I think when you start in the weeds, it gets confusing. But let's kind of take a step back and think of, okay, when we have somebody on COBRA, what do we need to report? And the most important thing to think about, and I'll say, I think what caused this confusion was the presence of 1G, which is one of the options for line 14 on the 1095C. It created this, I've got to use that for COBRA, and that's not correct. It is a code that will generally only be used for COBRA, but you may have somebody who's covered under COBRA that you would not use the 1G code for. So what we really look to is we say, is this employee currently employed, or were they employed at any point during the plan year? If yes, you're not going to be using 1G. So you look at the employee. Let's say you have an employee that had a loss of coverage due to a reduction in hours at some point during the year. So they were covered. They fell below full-time hours. In this situation, you'd likely be using the monthly measurement method. Well, then you would report really the just accurate information there. They were offered coverage for, let's say that change occurred in June. Offered coverage for January through June. After that, they were no longer offered coverage, and there's a code that you can use to show that they were not a full-time employee. That's code 2B. So you would report basically accurate information. That is a current employee. Same thing if the employee is terminated during the year. Then that means, using the same timeline in June, that for months thereafter, you're indicating that they were not offered, they were not an employee, so they were not offered coverage. Now, here's where the catch is. Even if that employee enrolled in COBRA coverage when they were terminated, you would not use 1G, which again causes that confusion. You would still report it like that employee is no longer employed and was not offered coverage. We know that you did offer them COBRA coverage. That does not change how you complete the forms, and that's where it gets kind of complicated. So the next slide goes a little bit more into detail with that. You use code 1G when the employee was either not an employee at any time during the calendar year, or was not enrolled during, or was not a full-time employee at any point during the year. Now, here's the catch. Think about, why would you be filing something for somebody if they were not an employee at all during the year and were not a full-time employee during the year, even if they're enrolled in COBRA? You wouldn't, right? Because what we've been talking about is you're filing as an applicable large employer. Well, you also have that obligation to file the B forms, but if we're a large employer, we file the B forms on the C forms. So hopefully the conclusion everybody is coming to, because I know it's confusing, is you're really only worried about this if you're a self-funded plan. Because in that situation, you are required to issue a form, even though that person is not a full-time employee or maybe was not an employee at all. You're required to indicate that they were covered. That's part of your requirement to file as a provider of minimum essential coverage. Again, it's the B forms, and it's a separate section of the code, but the rules effectively say use the 1095C to communicate this information. Well, to do that, you have to complete line 14 of the form, and that's where 1G is important. So that's why I kind of say, if we take a step back, the trees can be complicated, but when we see the forest instead of the trees, it becomes a little bit more clear. So number one, 1G is only going to be in question if you're a self-funded employer, and it's only going to be used when that individual was not an employee at all during the year or was never a full-time employee during the year. Okay, so now getting to these sort of best practices and these golden codes, and we'll talk about the Trump code. I want you to keep these in mind as you're completing your form, because it's kind of almost like a hierarchy of rules. And if we follow these, we're going to get through the reporting process as painlessly as possible. So when you're completing the 1095C, you've got two really important lines that correspond to two really important code series. You have the code series 1 and 2. Code series 1, which is the 1A, 1B, 1C, that goes on line 14. Code series 2, so 2A, 2B, 2C, goes on line 16. Line 15 that goes right in the middle of those is where we show the cost of coverage for the individuals. That's not a code. Those are going to be numbers there. When you're completing the 1095C, you have to complete line 14. in fact, because now we're all going to be electronic filing, the AIR system, which is the ACA information return filing system, will kick that form back to you and will reject your filings if you don't complete line 14. And you have to complete either every month on line 14, or there's an all 12-month spot. So, of course, if you enter your code there, it's going to apply for across there. But we can't leave any blanks in the line 14 months if we're completing the codes for each month. And again, that will cause your returns to be rejected. So you have to have a line 14 code. You don't have to have a line 16 code. In fact, you could leave line 16 completely blank and the system would accept your return. But we want to have a line 16 code. Line 16, which is the code series 2, is only for our benefit. It is effectively the line that says, regardless of what I said in line 14, which is the line that says, did you or did you not offer coverage, line 16 is saying, regardless of that, we should not be hit with an employer mandate penalty, and here's why. And then you use those codes to explain that. So what I want to drive home with that is, when completing your forms and reviewing them, look at line 16, and if you've got any blanks there, that's a follow-up question. That's a highlight. We want to know, why is that blank? Because if we can have a code there, which may not always be the case, but I think in a lot of situations it will be, you want to have a line 16 code. So the line 16 uses the code series 2. 2C is one of those codes. I call that the trump code, because kind of looking at a hierarchy of which code series 2 do we use on line 16, if 2C applies, you're going to use that code. There is a very small, and I wish this wasn't the case, because I'd love to just be able to say, hey, 2C is the trump code, period, end of sentence. There is a small, tiny sliver of a caveat to that for 2E that only deals with multi-employer plans. So if your employees are in something like a union plan that you're required to contribute to, there is what's supposed to be an interim rule, but it is still in place. That will actually trump 2C. If any of what I just said does not apply to you, so no multi-employer plan, no union type plan, no, you're not required to contribute on an employee's behalf, then 2E is not going to be in question for you. And so we get back to the easier statement of 2C is the trump code. That will almost always be the case. If you are in a multi-employer plan situation, again, that's one of those unique things that you may need some extra help making sure that you understand that rule, and if you qualify for the 2E relief there, and that's a perfect thing to reach out to your true consultant about. But except for that very small number of employers that might fall into that category, 2C is what's going to apply or is what you're going to use if it applies. And I've been meaning to get to the point where I say what 2C is. 2C is they enrolled in the coverage. So if you offered coverage to an employee, they said yes, that's your code right there, 2C. They may also have, that coverage may also have satisfied an affordability safe harbor. I don't care, we're going to use 2C. So that's going to be the trump code, again, except for that tiny exception. But if you're looking at, multiple codes could apply in line 16, and remember, we want to have a line 16 code, and that person enrolled, we use 2C. And one kind of explanation, I guess, of why that is the case and why it's also very beneficial to us is it doesn't matter whether it's affordable, whether it offers minimum value. If they enrolled in the plan, they're not eligible for a premium tax credit on the exchange, which means you cannot be subject to a penalty for that employee. The last bullet point here, offers of coverage, so that's line 14, are all or nothing per month, meaning that offer of coverage has to be effective for all days in that month for you to be able to use an offer of coverage code. 1E is probably the most common offer of coverage code for the line 14 code, and that means you offered coverage to the employee, the spouse, and their dependent. If an employee started mid-month and that coverage became effective, the 15th of the month, we can't use that offer of coverage code. We would have to use, really, it would be 1H there, because that means you didn't offer coverage to this employee for all days of that calendar month. Now, that would be bad, right? 1H, this is a full-time employee. That means we could be hit with an employer mandate penalty. Well, that's when, again, we always want to have a line 16 code, and the appropriate code there would be 2D because that's a limited non-assessment period, their first month of employment. So this is same idea with, kind of golden codes and best practices. This is a kind of map or decision tree that you can take to determine what line 16 code to use. Because again, I can't drive this point home enough. If you can have a line 16 code, you want one. It is only for your benefit. So the first thing that I always ask is, did we offer coverage to this employee? And remember, that's going to be in line 14. That should tell us that answer. So if yes, if you did offer coverage to the employee, then all you got to do is you got to ask yourself two questions. One question, two possible outcomes. Did the employee enroll in that coverage? If yes, we just talked about this and probably a little bit too much on the last slide, that 2C is going to be your code. If the employee enrolled, that means 2C applies, and that trumps the other one. So did I offer coverage to the employee? Yes. Did the employee enroll? Yes. Line 16 is 2C for that month. If no, that doesn't mean blank. That means we're going to go to sort of the next level. And because this is an offer of coverage, in other words, our question, did we offer coverage to the employee? And the answer is yes, but they said no. There's not a code that says we offered it and they said no. So then what we want to do, because remember line 16 is for our benefit, is we want to communicate that this employee's coverage was affordable. So even though they didn't enroll, they're ineligible for premium tax credit because we offered affordable minimum value coverage to this employee. So that's where you would use your affordability safe harbor code. We talked about those earlier. 2F is the W-2 safe harbor. 2G is the FPL safe harbor. And 2H is the rate of pay safe harbor. And one thing that I should mention, when you're going through this, and you'll be working kind of hand in hand with whether it's your true consultant or your payroll provider or an ACA service provider, or maybe us or your attorney, you'll be walking through this, right? And so a very good tool, and to the IRS's credit, the instructions for these forms. I'm not saying they're the simplest things in the world, and as you can imagine, longer than they need to be, but the explanation of the codes is fairly straightforward. So I would encourage you, download those forms. They come in, the PDF is also kind of very well laid out. So that's a great tool for you to use. And of course, refer back to this webinar. That's why we want to have this available for you. And that's probably a good time for me to mention that we will make the slides available, and the recording of the webinar will be available through your true consultants. But so use all the resources at your disposal, but including the 1095C instruction. All right, so back to our decision map here. So go back to our first question. Did we offer coverage to the employee? If that answer is no, now we need to determine, okay, why not? Was the employee not employed? Because we're not going to offer the coverage to the employee if they're not employed. If that's the case, okay, the answer is 2A. Remember, that does not apply for a COBRA offer. In other words, when we ask, did we offer coverage to this employee, we're not talking about COBRA coverage. We covered that under the 1G and how we answer those questions. We don't treat COBRA coverage as an offer of coverage. And so did we offer coverage to the employee? No. Why not? Because the employee wasn't employed. Maybe that's before they were hired. Maybe it's after they were terminated. But either way, if they weren't employed, that's 2A. Again, we want a line 16 code because we can't, or because it's for our benefit, and we can't be penalized for not offering coverage to a non-employee. All right. What if the answer is, did we offer coverage? No. Why not? Because they weren't a full-time employee. That's fine. There's a code for that as well, 2B. 2D is where it gets a little bit complicated because there's a lot of instances where 2D may apply. But that also means it's kind of a Swiss Army knife, right? We can use it for a lot of situations. The most common is a waiting period. So you have an employee that started, they're a full-time employee, they're eligible for coverage, but you have a waiting period under your plan. That would mean 2D. Even though I think a lot of times in talking, we say, yeah, that employee is offered coverage, it's just not effective until they've satisfied the waiting period. For reporting purposes, we would treat that as the period during the waiting period as not an offer of coverage. In other words, a 1H in line 14. But in line 16, again, only for our benefit, why didn't you offer coverage? Well, because it wasn't effective until they satisfied the waiting period. So for each month of that waiting period, you would use 2D. Once they had then satisfied that waiting period, your answers would change, and it would be 1E, if that's your because again, there's different offer of coverage codes for line 14, but 1E being the most popular of offered it to the employee, dependents, and spouse. So the 1E, and then again, now we're back to our question. Did we offer coverage? Yes. Did the employee enroll? If yes, 2C. If no, we're using our affordability safe harbor. So that's the process to go through. I don't think you can get more simple than that. There are some questions that can arise in that process. This will get you where you need to be for the vast majority of employees. If there's a very complicated, very special situation, that listen, they happen. Every year we help employers walk through, kind of some of these just more complicated situations. That because, you all being in benefits and HR and the employer aspect of the law here, having to pay attention, that there are unique and complicated circumstances that come up. When you think you've seen everything, something else comes up. So there are going to be some special situations, but this will get you through the vast majority of forms for your employees and completing the 1095Cs. So a few lessons learned, and these really are lessons learned from us helping employers with the reporting, and then from the employer mandate penalty notices that some of our clients have received. Learning, what could they have done differently on their reporting? What questions should they have asked? And then also how to respond to those. So when you are completing your filings, I mentioned earlier, we had the good faith standard. Now we're on the reasonable cause standard, which is significantly higher than the good faith standard, but it's a relatively low standard, and we can meet that standard and have in representing a lot of employers. But it is more difficult to establish reasonable cause than it is the good faith. Something that we absolutely want to be able to represent to the IRS is that we review our forms. We have a practice in place for how to do so. And, if there was a mistake that occurred, that's not due to what the IRS says is willful neglect. Mistakes do happen. That doesn't mean that it was willful neglect. It was due to reasonable cause. We want to be able to say, it is our common practice to review our forms. I have to especially review Form 1094C because it's really easy to review. It's, number one, it's a little shorter. You only have one of those that you're submitting. And I've got it on a slide, maybe either the next slide or the one after, what to review that'll avoid a lot of penalties that our clients have received that they really just shouldn't have had to deal with the headache. And normally it was a mistake early on in the process, and a lot of times it was not anything due to the employer. It had something to do with the payroll software. But you want to review to the 1094C to ensure that information is accurate, and in particular, where it indicates whether or not you offered coverage to at least 95% of your full-time employees. Line 16, I think I've said this more than anything else today, make sure you have a line 16 response, if at all possible. It should be blank as a last resort. Line 15, that's where you enter the cost of coverage for the employees' cost of coverage for single-only coverage. Something important with that is that may not be what the employee actually enrolled in, right? We only, for purposes of the employer mandate, are concerned with the cost of single-only coverage. Even if that employee enrolled in family coverage, which necessarily has a higher premium, we're concerned with the cost of single-only coverage. You will complete line 15 anytime that your line 14 code is an offer of coverage code. So if it's 1H in line 14, you would not complete line 15 because that's saying we didn't offer coverage, so it wouldn't make sense to have a line 15 response. And again, that's something that can cause your filing to be rejected. The only exception to that is if you use 1A, which we talked about earlier, is the qualifying offer method. The instructions tell us not to complete line 15, and we've actually had employers do it both ways. Sometimes it gets through, sometimes it gets kicked back. But the instructions, if we follow those to a T, they say if you use line 1A, do not complete line 15. And again, it can cause your filings to be rejected. So if you're using 1A, you wouldn't want to complete line 15. Just to reiterate, that doesn't mean you don't want to complete line 16. If you can complete line 16, you want to complete line 16. Hopefully that's the last time I say it, but I want you to all make sure that you hear it. Code combinations are important. This is something that we've seen be kind of an issue with the IRS whenever they assess a penalty on an employer, especially an employer mandate penalty, when there's inconsistent codes. It can also cause your filings to be rejected. And what I mean by inconsistent, I just said one, if you have 1H within completing line 15 saying line 14 says 1H, we didn't offer coverage. Line 15 says that coverage costs X amount of dollars. That doesn't really make sense. So by the same token, saying 1H, we did not offer coverage, and then in line 16 having 2C, the employee enrolled in coverage, those don't make sense. Those are inconsistent code combinations. And what that can cause is, number one, potential for your filings to be rejected, but it can also cause information reporting penalties. Now, those are things that, again, can reasonably happen. I feel confident that we can represent to the IRS that is an error that was caused by reasonable cause and not willful neglect. But the goal here is to prevent that on the front end so that you're not having to deal with that headache. We all know you've got enough on your plate. So if we can get this right on the front end, that's where, again, it's important to review the code. With the affordability safe harbors, keep those strings in mind, and you can refer back to the slides where we discuss those. We're in January now. We have that automatic extension until March 2nd to get these forms distributed to the full-time employees. So it's important to get started as soon as you can. In talking with True, we thought January was a good time to cover this information because now is when you're really getting into ACA reporting season. This is fresh on your mind. You're completing these forms. You're working with your service providers to get those completed. So that's why we want you to have these rules and this knowledge on your mind now. And so in working with True, they thought this was a good time to bring that information and would be the most helpful time. So a few follow or final items here. Remember, good faith transition relief has gone. So standards for being or having incorrect information reported is more stringent and harder to convince the IRS that there should be no penalty associated with it. If we can show we have good practices, we reviewed the forms, errors and mistakes do happen, but it's not due to willful neglect. That's the position you want to be in. Always save PDF files of your forms. When you receive these penalties, it's years down the road, as we've mentioned a few times. So you want to be able to have those forms kind of readily accessible. You may get something from the IRS saying, we never got your form. And then you can show that, here are our PDF forms. How would we have these if we didn't create them? You can also, in that situation, provide them. Sometimes they'll request the receipt ID, and that'll be probably universally requested now that everybody's required to file electronically. The receipt ID is what you get when you submit electronically, and you can just save that for your records. Something that I like to do is to email that to myself, with the idea being I now have that record. It's a time-stamped record, right? When I send myself an email, it tells me the exact date and time that I sent myself that email. And so you can keep that, put it all. I like, just kind of old school folder on my computer. You can put it on your desktop. Here's 2023. You open that up. You got the PDFs of your files. You have your email saved that has the receipt ID. You can also print, a copy of that page. But keep all of that together and organize. That makes it much easier if and when you have to deal with the IRS to show that you comply with all those rules. I think a good practice is sort of to spot check for those code combinations, because I mentioned you can have inconsistent ones that can cause your filings to either be kicked back or result in penalties down the road. I like kind of using a bucket method, which is where I say, okay, I know all of these employees were full-time and offered coverage. So I can check a sampling of those employees. I know these are mid-year hires. I can check a sampling of those forms. I know, if you're a self-funded employer, I know these people were never employees during the year, but we offered COVID coverage, and you can do a sampling of that. That way, because depending on how many you have to review, it may be a significant number. That makes it easier to review. And again, document that practice. This was our practice in filing and reviewing our forms, so we can show that any failure or any error was due to reasonable cause. The very last one here is what I alluded to earlier in terms of reviewing the form 1094C. Here's where you want to look. This is the second page of 1094C. You'll see, did you offer coverage to at least 95% of your full-time employees? That's where we want to make sure that we can say yes. That avoids the A penalty. You can use the all 12 month box, or you can use a check mark in each box. But we want to make sure that this is correct, because if it's marked no, you will receive a penalty. All right, so real quick in closing here, I mentioned that I had the 2024 numbers for everybody. Here are the numbers that are applicable for 2024. Now, this does not affect your 2023 reporting that you're doing in 2024, but just wanted you to have this for your reference. You can see the A and B penalties have both increased. That'll happen every year. And the new affordability percentage for plan years beginning in 2024 is 8.39%. And one last slide here, just real quick. I just wanted to bring this up. We've still seen a lot of employers not have a comparative analysis for their NQTLs for their group health plan. It's a requirement for all plans, and we have seen the DOL be very active in requesting these. If you receive a DOL inquiry, and in particular a DOL audit inquiry, this will be on the list. It is now a standard item on their subpoena for audit, and it can be very problematic if you don't have it, and it takes time to do. So it's not one of those things where, once you get asked for it, you can kind of start taking action. So it's something I would just encourage everybody, double check. Maybe you have done it. Maybe a service provider for your plan, your TPA, or your insurance carrier, maybe they have a comparative analysis that you could piggyback off of, or that may be fully sufficient. But it's important to go ahead, start asking this question, start determining where you are in that process. And, as always, document what you have done towards that, so that if and when the DOL does come calling, you're able to show reasonable compliance efforts. So that does bring us to the end of today's webinar. I appreciate you sticking with us. I know we went a little bit over our time here, but we wanted to have all of the information you need for your 2023 calendar year reporting during the 2024 ACA reporting season. Again, we will provide a copy of the slides and a recording of today's webinar to your True consultant. So please reach out to them for those. Again, thank you for joining us today, and have a great week.